Good afternoon, everyone, and thank you so much for joining us. I'm Ted McHugh, Managing Director here at Edelman Smithfield. Quick introduction, we are a financial communications and IR advisory firm, and we help companies, both private and public, navigate the capital markets. And we are super excited to be here today to host a great panel discussion on the state of the IPO market. We've got a tremendous lineup of speakers representing both the financial media, but as well as investment banking, and as well as buy side and sell side perspective. So we've got a great panel. We thank you all for joining us today. Before we turn it over to the moderator, I just wanted to quickly highlight that we're hosting today's event in connection with some research that Edelman Smithfield launched this morning on the state of the IPO market. We interviewed over 100 institutional investors, many of them being quite large in size with over 50 billion in AUM, to really kind of get an understanding of the buy side's perspective of the state of the IPO market today. And importantly, sort of how their expectations have evolved since the last cycle of 2020 and 2021, recognizing that we've been in a bit of a drought the last 2 years as it relates to new issuers. So really great research that we launched this morning. I encourage you all to check it out. It's on our the Edelman Smithfield website. But just real quick before I turn it over to the panelists, just wanted to highlight a couple of really important key takeaways. One is the feedback that we got from global investors that they believe we are at the verge of the next IPO cycle. They believe that the IPO market should reopen in the back half of 2024. Not surprisingly, their expectations about an IPO market reopening are closely tied to where the Fed lands on interest rates. Our survey found that the investment community expects at least 50 basis points in rate reductions for them to feel kind of certainty or confidence in the reopening of an IPO market. It is important to note that our research was conducted during Q1 of this year. Some of the more recent chatter around Fed actions and inflation staying around a little bit longer than initially anticipated, needs to kind of be anticipated despite our findings. Second is, regardless of when the market reopens, we heard loud and clear from investors that they are eager and have appetite for new issuers coming to the public markets. They see this as the beginning of a cycle suggests high quality companies coming to market at potentially more reasonable valuations. And so lastly, as we dig into sort of what quality means, there's a couple of things that jumped out at us as it relates to our research. The first is being leverage. Investors' expectations for new issuers in terms of their balance sheet has evolved. And now their expectations are anything sort of greater than 2 times leverage could be excessive. Second is a balanced financial profile. Not surprising, sustained revenue growth is a key metric for evaluating a new issuer, but it must be balanced with long-term profitability, earnings quality, and importantly, free cash flow are things that we heard in our research. Third is the importance of liquidity, trading liquidity. Institutional investors are sensitive to a lack of liquidity in new issuers and whether or not they could take a position that they can manage and trade. And lastly, the importance of strong corporate governance for new issuers. Particularly, our research found the desire to see public company experience on the boards of these new public companies is critically important when evaluating sort of the governance structure and leadership of public companies going forward. So just a few key takeaways from our research. Hopefully this will set the stage for our panel. And so I will turn it over to Brian Sozzi, executive producer at Yahoo Finance. But I also encourage you all to ask questions. There is a Q&A function in the Zoom link. And so I encourage you to submit your questions and we'll do our best to take them. And so I'll turn it over to Brian.
Thanks so much, Ted. This was really, really good research. Happy that we were able to share it on Yahoo Finance. But in short, I'm Yahoo Finance's executive editor, and my day so far has started with an interview with the CEO of PepsiCo, CEO of Snowflake. I've resolved a conflict between an editor and a reporter. I did an HR training class, and then I have 7 conference meetings by the end of the day. So that is a little insight into what an executive editor does on any given day. Definitely vary. But we have a really amazing group of panelists here. I'm psyched to hear what they have to say on all things markets, IPOs, and investing. Jane Dunleavy, Global Head of Internet Banking at Goldman Sachs. Jane, it is just so great to have you here. Maybe you could tell the group what you're working on, your background in under 30 seconds, so no pressure.
Thanks, folks, for having me, and great to be here. I sit on the West Coast. I lead our internet business with a big focus on tech, and we've been lucky enough to be at the forefront of leading the IPO reopening. Look forward to talking to you all about it.
That was perfect. Awesome. Then we have Barbara Miller, Vice President and Senior Portfolio Manager at Federated Hermes. And Barbara, I think you could pull apart a financial statement like no one else can.
Certainly can. Thanks for having me. Been with Federated Hermes Kaufman Funds for about 22 years. We manage $10 billion across 3 growth funds. We regularly vet companies pre-IPO and during IPO. We source a lot of new ideas. So I've seen many, many, many deals. We're a team with different areas of expertise. Mine, broadly speaking, focuses on consumer. And prior to being on the buy side, I spent a decade on the sell side as an analyst at Goldman Sachs and Alex Brown. First IPO roadshow I ever saw was Starbucks. So,
wow,
nice. A lot of
nice
perspective.
That's cool. And then lastly, Kimberly Greenberger, Senior Advisor, Edelman Smithfield, former MD at Morgan Stanley. And I will just say this, I was an analyst for 10 years, and I basically grew up idolizing Kimberly's work. All very, very true, but just amazing work that Kimberly did.
Thank you so much, Brian. An unsolicited compliment. I'm really happy to be here on this panel, and I just retired last year from Morgan Stanley. I was a sell-side analyst for just about 25 years, and about half of that with Morgan Stanley. So I got a chance to live through the torrent of IPOs in 2020 and 2021. I'll call it survive rather than live through, and I'm happy to be here to share my thoughts today.
All right. Well, very just amazing backgrounds and experience. So let's kick this off. You know, in our prep calls, you know, we really were talking a lot about the buy side and their views on the IPO market this year. And Jane, let me get over to you. You know, there seems to be, in talking with the group, but also like talking to a lot of sources and context I have on the industry, that they're expecting the buy side for the IPO market to pick up as the year progresses. What indicators are you looking for to help support that view?
Yeah, it's a great question. And I'd almost start with the macro. We've obviously been through hotter than hoped CPIs in February and March, and the market is digesting and scaling back their expectation for rate cuts. You know, our house view today is that we'll see 2 rate cuts this year, the first in July, and then in 25, we'll see a rate cut once a quarter. And I think the reason that we're starting to see these types of green shoots and IPO markets that we're going to talk about more is, you know, the market has weathered really significant change and largely has fared better than we feared. If we rewind all the way back to June of 21, you know, CPI is meaningfully lower, unemployment is meaningfully lower, volatility is roughly flat. But at the same time, 10-year treasuries have gone from, you know, 1.5 to 4.5. And so we're living in a much more normalized valuation environment. But that kind of gives you a sense of the type of indicators we're looking at and the reason that we think volumes are starting to ramp in earnest and will normalize in 25 as we think about the IPO market.
Barbara, is the outlook for IPOs is really the main factor in when something comes to market or maybe not coming to market this year? Is it really the outlook for rates?
In part, it's the outlook for rates, and I would echo Goldman's view. Federated's view is that we'll see a couple of cuts starting in July. We have never been as aggressively focused on many cuts as some others on the street. That's part of it. Part of it is the overall market performance and appetite for buying stocks. And then there's finally the quality of whatever company it is that is coming out. There's always an appetite for a strong story, almost regardless of market conditions, but certainly in a more robust market, that'll be the case.
Jane, do you agree with that? Let's say rates stay where they are for the full year. I think I saw an FT story this morning suggesting maybe we get a rate hike. I mean, that's not something we've heard for a while. Could a a strong, fundamentally strong company come to market with that backdrop and still be well received?
Yeah, I think Barbara's exactly right. I think one of the things we find encouraging when we see the type of IPOs that are starting to happen is actually how diverse they are across sector, across growth rate, across scale. Now, they certainly have some commonalities, and we'll get into this. On average, they're larger. On average, they're more profitable. But it's a reminder that the building blocks, the core dynamics of great companies can go public in any market. It's a question often of valuation and of tactics, and we'll get into that, I'm sure, in the hour to come.
Kimberly, before we move to the next question, going back to when you were on the sell side and you're covering all these companies, was it harder in high interest rate periods to get a successful IPO out the door, or sell that story, or talk about that story?
Well, we haven't been in a what I would call a high interest rate environment since before the financial crisis in 08 and 09. And back then, if you look at the period sort of 1999 through 2008, in consumer land, which was my focus, it was really high quality companies coming to market. J. Crew at the time was one of the hottest consumer retail IPOs. And went out at a very, very healthy valuation. Of course, in tech, there were a couple of cycles between 1999 and 2008. So in tech and internet land, they went through probably 2 full cycles during that period. But I would say once the market gets adjusted to whatever the interest rate level is, then interest rates can fade into the background in terms of their level of importance. And then what becomes a lot more important is valuation on the aggregate market, the valuation on the companies that are coming to market, and how those companies look in terms of their growth prospects and profit prospects relative to the market in aggregate. And I think Barbara and Jane have it exactly right. There is absolutely always room for high quality stories to come out.
Well, that perfectly sets up our next few. Over the past, I'll use the year time frame, we've had some big names, Reddit, Birkenstock, Kava, Ibotta. I'm supposed to be down later this week talking to the Rubrik team. They're going to debut down to New York Stock Exchange. Out of all these companies, Jane, what are some of the common themes that they're out there talking about on the roadshow in the hopes that they are a successful public company, not only on day 1 or day 2, but months and years down the line?
No, it's a great question. And I think we touched on this briefly. On average, companies that we see debut in 23, 24 are larger, are already profitable, or in that inflection point than their brethren of 2021. That said, I think many of the companies you mentioned have a really compelling durability of growth and ability to scale margin story. Now, we're encouraged by how different the companies you called out. Some serve consumers, some enterprises, software, internet, consumer. But that durability of growth, compounding advantages of scale are certain commonalities. The other thing I'd highlight is how deliberate and tactical companies in this environment are in how they are educating investors. I know Barbara will give you specific insight around this as well, but on average, we have companies doing 30 to 40% more meetings in the lead up to being public, being incredibly deliberate around their disclosure, around the key performance indicators that they want to talk to investors about as a public company, because the market is discerning. But we really think for great companies, that thought exercise, that partnership with investors can be really additive as they execute as public companies for years to come and create value for their shareholders.
Yeah, Barbara, let me get over to you. I mean, how do you name? You have Reddit, Birkenstock, Kava, Ibotta, like I mentioned, but others I'm sure that I've missed. What themes are you looking for? Surely there's more at play here than AI. Like I don't see Kava selling, having robotic lines with AI-powered salad bowls. I mean, they're not there yet. Maybe they come in 2 years, but I mean, there's other things to look at.
Well, it's interesting, Chipotle has a chip making robot, so you never know. There's lots of ways to skin a cat, but in consumer land, it's always about creating demand. And is it a brand, a company that is either changing the way we're doing something, hooking into a trend that's wind at their back. Kava is a healthier option from a food perspective. Is it a technology that's going to create more efficiency or let us do something differently? So from a growth investor's perspective, we always want to see something that has durable growth for a reason that is new, different, and in many cases game changing.
There is a question, and I that in the box I think applies here, so I didn't want to save it to the end. Barbara, it might be for you here. A lot of companies are out there, roadshow, even months after, hyping generative AI. So, what do you tell investors or companies that come to you and say, "Hey, we are creating this next big Gen AI thing"? Like, how do you determine that they're going to be successful, or maybe they're just a lot of fluff and you don't put money behind them?
Well, we really try to understand what is the data they're creating, what are they enabling by doing that, and in some cases, how is a company using that data differently to run its business? I mean, there's no question that this is a compelling technological development. It's early, it's new, and none of us are really going to know the extent of what it does for some time. But we have to understand, if a company is in that business or spending on that business, what's the strategy, why, what's the end game for that investment?
Jane,
I think that
go ahead.
the IPOs that you've seen are probably good examples that there are different lanes of companies talking about AI in public markets. There are very few companies that own models. That's a small set. Many of them are public. Many of the companies that investors are asked to evaluate in an IPO context talk about things like basic efficiency of a call center and customer service. That's already easy to quantify, and companies doing a great job. I think one of the open questions for companies as they debut is, how much can AI influence the revenue formula? Can it be effective in driving personalization for consumer businesses? Can you productize an AI assistant the way that many software companies have? And to us, at least, it feels early in the kind of formal, how will it improve the revenue of the business if we're starting to better understand efficiencies that AI can drive on the cost side?
No, that's a really good point, Jane. Before I came on here, actually, I talked to the CEO of Snowflake. So they have a lot more AI things coming out. Of course, that's what, 2020 IPO. I mean, how do you make sense? How do you help investors make sense of some of this stuff where, in Kimberly's space, you can go to a Macy's or Nordstrom or American Eagle and you touch and feel their things.
Yep.
So I'll be honest, look, I had really no idea what Snowflake was telling me. It all sounded good, but maybe it's not.
No, but I think you're getting at something important, which is that companies need to be thoughtful around what is here and what they're going to put in models and talk about and promise investors, and what are really interesting upsides. I think great companies are talking about both, but committing to the former, and keeping investors posted and their customers posted as they execute against the latter.
Let's go back and I guess just go back and channel your experience here. Kimberly, let's start with you. What was it like covering that IPO boom of 2020 and 2021? I'm just going to mention Snowflake real quick. So I think the first price they opened up was $245. The stock's trading at $145 now. So it's not exactly all those companies that came public in 2020 and 2021 have had amazing experiences with being public.
Very good point, Brian. If you look back at the data, I think something on the order of 90 to 95% of those IPOs are actually trading below issue price today. There are definitely a few exceptions, and those companies have proven that they have a durable brand or some durable revenue growth. They've also delivered on the margin expansion, and generally those companies were within, call it 1 to 1.5 years of profitability. And so they could sustain cash flow. And it was those combination of factors, I think, that allowed those companies to really thrive. What we saw in the IPO boom of 2021 is you had a sort of almost historic low rates market. So when you put a new business model into a discounted cash flow analysis, which is something that we are very disciplined about doing at Morgan Stanley, what you get is a pretty nice valuation if there's a 5-year story that sort of gets you into some nice positive free cash flow. What we lack today are two things compared to that period of time, in my opinion. Number one, the 10-year treasury is not at 3%; it's at 4.5%, and who knows, maybe heading higher. It's tough to call. And secondarily, the market saw so many companies that were benefiting at the time from a really unique economic cycle. And it was very difficult to anticipate vastly changing consumer behavior. And that changing consumer behavior between 2020 and 2023 really affected those forecasts of profitability, cash flow, and of course, revenue. And so that level of disappointment and that inability to accurately forecast the future really, I think, scarred a number of investors. And so what they want now, what they're asking for, at least my read of the survey results conducted by Edelman, is that they want a nearer path to profitability, very short term. They're more focused on balanced financial metrics, revenue, free cash flow, and gross margin. They were almost tied in the survey. I think that is very interesting. And what it tells you is that investors are absolutely willing and happy to look at IPOs, but they don't want a long forecast to get to the financial metrics they need to make the model work. They want it shorter term. And then, as Barbara said, sort of a stronger or a more durable path to growth. And now, hopefully, that the volatility in behavior and consumer behavior has settled down, maybe the future forecasting can be a little bit more accurate. So I think that's how I reflect on that time. But a lot of things clearly got out to the public markets that maybe really weren't yet ready, particularly given the volatility behavior we saw.
No, it's a really good point, Kimberly. Barbara, I'll toss that over to you. Do you think the companies that would come public, let's say over the next 18 to 24 months, they're more complete companies than they were in 2020 and 21? They have more substance, I guess, behind them?
Well, I think so. I mean, look, 2021, it was kind of a new definition of the terrible twos. Too many companies going public, too little preparation. Some of them were too early, some of them were too late, too expensive, too unprofitable, and frankly, too easy to pump out because everything was being done virtually. We were in the middle of a pandemic that nobody in our lifetimes has lived through. So, I think now we're back to a more normalized environment from many of those perspectives. And the expectations on the buy side, as Kimberly said, are for companies that are more prepared, more complete, and business models that have durability and reasonable growth with stronger cash flow, stronger earnings or earnings prospects.
Jane, let me toss one over to you. And another question that came in, I'm just going to answer early because I think it applies to what we're talking about right now from Gibbs Smith. I remember reading the Reddit prospectus, Kava prospectus, and I came away thinking, the corporate governance seems a little better than it was, 3 or 5 years ago on companies that came out. And I guess some companies are still dealing with, dual class structures, you name it. But what's your sense of the corporate governance on some of these new crop companies preparing to go public?
Yeah, it's a good question, and it's certainly an area of focus. I do think and I'll give you a very specific tech lens. In many tech companies, we continue to see some sort of differentiated voting structure. That's sometimes just a founder, it's sometimes multiple founders, it's sometimes all pre-IPO shareholders. I think what this market is most focused on, even when that is appropriate, are substantive guardrails around that differentiation, whether it's sunsets, whether it's time. And I think we're striking happy marriages of some differentiated focus to a founder who has grown a business, but certainly guardrails around the roles of other shareholders as companies come public.
That's a good one. The next question I think is a little It's a little wonky for me, so I'm actually just going to read it off the paper that I have right in front of me. I mean, how do you think about stock liquidity, Barbara, and the anticipated stock float? Like, what is the right amount of float? That's not something I think a lot about, but it's very important to investors, I'm sure.
Well, and it is important, and it also depends on the size of one's fund. But if you just take as an example, if there's a $4 billion fund, small cap growth fund, and it has 100 positions, and I'm not saying that that's our fund, but just as an example. So each position on average is 40 million. And in an IPO, an investor wants to start building that position. You have to get enough traction, say 15, maybe 20 million, half the position, without owning so much of the float that it creates volatility if there's some trading warranted in the process. So if you do the math on, say, we want to own 5% of a company's float, that's going to be about a $400 million float. And then it comes down to what percentage of the company is being sold. I also think that a lot of the companies that went public a couple of years ago had big private equity ownerships, and not much was sold in the IPO, and it creates a big overhang. We all know that private equity is in the business of selling over time, and that's fine. But if the company doesn't perform, it's almost becomes put in purgatory, because the investors can't sell, and investors on our side, if we see that, and then we see the stock go up a little bit, we know that the private equity is going to want to sell. So it's a little bit of a push-pull. It's a long way of saying that we should have sufficient liquidity to create trading ability and the ability to build an initial position. And then we want to see the company perform. And over time, if private equity is selling, they'll be able to do so.
Jane, the companies that you're interacting with, what's their view on what Barbara was just talking about in terms of liquidity? Is it
No, it's a really good question. And I think the careful balance, especially in an environment where valuations may be lower than their expectations, is that push-pull of, do I dilute myself by raising primary capital? But I want to ensure that I have a normalized float, so great investors like Barbara can own enough of the company and have conviction that they can start to do that in the IPO. One of the happy realities of this market is we've been successful putting more secondary into the IPO itself. And as Barbara illustrated, that contract is sometimes a nice middle ground where it's visible to the investor that some of this supply will come in the IPO, and they know it won't come later. So take Reddit or Ibotta. These companies both floated between 15 plus and 20+% of the company in the listing, both sort of profitable in the quarter in which they're going public. And so they don't need massive amounts of primary capital. And the balance is to say, we've been around for more than a decade. Our employees own a meaningful part of the company. Let's let them sell some in the IPO. Let's let a few early investors who are not public shareholders own the company. And that's been a nice balance in these deals. And it's something we expect to do more of over the balance of the year.
Kimberly, is it hard to model companies that don't get it right on float? I mean, how do you come up with a fair valuation?
It's very tricky. It's incredibly difficult to actually adjust valuation for float. What we often find is that the largest institutions in the United States, if the float is not sufficient, the largest institutions in the United States, including the one that Barbara works for, may not be able to participate in the IPO if there's not enough float. And so the risk is that the offering, it's possible the offering may not be as well subscribed, and that affects more IPO valuation. Once a company is public, it's very difficult to adjust a discounted cash flow statement or an EBITDA multiple analysis in order to figure out what a fair valuation haircut might be for a very illiquid stock. What I will tell you happens is that in the normal course of being a sell-side analyst, You'll go into meetings, in-person meetings or phone conversations where the investor on the other side would say, you know, I see you have a favorable opinion on XYZ or ABC. I'm just going to tell you now that it's not something that I can even invest in. So let's skip that one and move on to the ones that are more interesting, that sort of meet my threshold. And then, as Barbara said, you just end up with orphans because there's no interest in the market, and investors who really have a lot of investable funds, the largest institutions, are just unable to get involved.
Barbara, before we move to the next topic, what is a good public float percentage for investors?
I think as Jane mentioned, the 15 to 20% is something we see fairly often, and it leaves room for more over time. But again, depending upon the initial dollar size, it may leave enough for the first tranche of investors to get involved. It really just depends on the company size and scope.
Interesting.
But I would say just on the whole question of valuation, if a company has a relatively low float but is performing well, and an investor can't own it purely because of the float, that does create demand and opportunity for secondary sales. And if the company continues to perform well fundamentally, it'll take care of itself over time because those secondary sales will happen, new investors will get involved, the float will improve, and it should work out over time. So really the fundamentals help to drive the appetite as much or more as the valuation.
That's a really good point. Let's stay on fundamentals. And Kimberly, I'll toss this one over to you. You know, on Yahoo Finance, what I posted from Edelman Smithfield's research was this one chart, you know, looking at what investors are really looking into right now or to scrutinize an IPO. And I always thought, well, of course they're going to look at profits. That's obvious. But there's a lot of focus too on, you know, revenue and other items. You know, what are some of the trade-offs you're seeing companies make, and even investors, you know, look into right now as they try to assess these companies coming public?
It's a great compare and contrast question, Brian, because when I think back to 2020 and 2021, the first question out of investors was typically, how fast is it growing? And by how fast is it growing, they were talking about how fast is the revenue growing. And so there was this really strong focus on top line. And in part, it was because we were living through a time where there was just, you know, an extraordinary acceleration in revenue growth that was quite appealing. And so there was, I would say, more of a singular. It's never just one item on the income statement that investors are focused on. But during 2020 and 2021, there was a heightened focus on revenue growth. Today, it's a much more sort of balanced expectation that investors are looking for, and revenue growth, free cash flow, and gross margin were almost nearly tied in the investor survey, the slide you're referring to, Brian, and in the Edelman presentation. They were nearly tied. I can't remember. I mean, I think you would have to go back to the middle 2000s to find a time where you know, it was really truly that balanced. And what that tells me is that investors are looking for a more complete, sort of holistic way to evaluate a company rather than through a singular lens. And what those three things, revenue growth, gross margin, and free cash flow, what they have in common is that they are a great, if you take them together, it's a great representation of what the business model can produce in economic value. And ultimately, that's what investors are looking to uncover when they're looking at IPOs coming to market.
Jane, yeah, let me get over to you. I think back to some of the IPOs of the past decade. I remember Shake Shack when they came public. It was an easy to understand metric. Same Shack sales. Like, it's catchy. It's essentially same store sales. I mean, it's not rocket science. But at this next group of companies coming public, sure, we're going to focus on revenue and profitability, EBITDA, you name it. But are there new buzzwords like they're going to start using, like profits per Gen AI seat? I don't know. Like, what are you hearing from companies?
It's a good answer, and I'll admit I'll give you a somewhat fundamental response, and what Kimberly talked about entirely resonates. A slightly more tech-oriented focus, I think, which is a helpful reminder, is most companies do have to grow their way to some profitability. And that's why this focused on the balanced picture is important. Incremental margin is really important in almost all businesses. And if I look at a composite of tech today, things like Rule of 40, so this combination of growth and profitability are really important. And what those correlations would tell you is, while profitability is important, a point of growth is actually worth more. It's worth more in the DCF, and it's worth more in today's market. So the balance is important. Things like incremental margin, what's your margin on new dollars of revenue you're generating? That's sort of a composite matrix that investors are focused on in this environment.
Barbara, is there one or two metrics that you're really keying on now, maybe beyond the obvious, or is it still tried and true? You want to see companies growing their sales, accelerating earnings, especially these early stage companies?
I think we want to see growth, sustainable growth, and understand how a company is going to get to its longer term objectives. We do want to see profitability, if not immediately, certainly on the horizon, and evidence of profitability at a level, whether it's gross margin or take a restaurant company, restaurant level margins being strong, but having to grow into their corporate G&A. And we look at cash flow. And frankly, I don't really believe in saying it's different this time. We're gonna create a new metric, because businesses, regardless of the sector, have a top line, have expenses, and have a bottom line. And understanding how the business gets there and stays there and grows is just, very important.
Well, I'll stay with you, Barbara, because let's say a company that is, and this is one of our next questions, come to you and we're accelerating our revenue, we're accelerating our EPS, but then you look at their balance sheet and they're over leveraged. What's your reaction, and then what's your next move?
Well, I want to understand, where did the debt come from and why? And how much is it going to cost from a capital expenditure and expense perspective to accelerate that growth, versus what happens if the growth is instead of, say, 30%, 20%, but the cash flow is a little bit better? And what does that mean for the business? Not a big fan of high debt. Because, for obvious reasons, if economic cycles go the wrong way, it's not a fun place to be. Some business models support it better than others. Models with recurring revenue, models that are franchised, there are reasons for debt that make more sense than other models. But generally speaking, less is more.
Kimberly, let me get over to you on the debt question, because you have, I think, maybe an interesting view. Sure, we have long-term debt, but on consumer companies, you have leases. An environment where rates, let's say they stay at current levels. I mean, how do you balance those things?
Well, there have been recent changes in lease accounting over the last few years that have caused those to come on balance sheet. So it's very easy now to do the analysis, but we always to have a complete picture of a retailer, you really do have to look at the lease liability as debt, and it's easier now than it was, but that's super important. In terms of leverage, the challenge with leverage, and I think the reason you're seeing such differentiation between investors who are fine with 1 to 2 times leverage, as the survey showed, but really anything above 1 to 2 times is just not tolerated. I think the reason you're seeing that differentiation is that if a company is 4 to 5 times levered and their profit falls short 2%, the equity goes down 10%. That's what happens with leverage, right? Because the debt value does not change. The equity value has to make up the entire amount of the shortfall. And so what you get is enhanced volatility in the stock price on very small gyrations in EPS if you have that 4 to 5 times leverage. And most investors are fine with upside volatility. But when you introduce stock price volatility to the downside, they realize their risk tolerance is not quite what they thought it was. And so that's really what I would say is the biggest challenge to having too much leverage, is the fact that it creates an almost annoying level of volatility in the stock price, and that can make an equity uninvestable or less investable.
Yeah, I'm really, this whole conversation is reminding me, I'll just use Reddit for an example. I didn't really do a deep dive in their balance sheet per se. I guess it's not my job anymore to do some of those things. I mean, we're driving headlines, but still, I should have did more like research. I mean, Jane, like the next crop of internet companies, what do their balance sheets look like? And what are you telling some of these leaders at the company?
Look, in growth tech, the vast majority of companies have no leverage. So our job is simple. I do think one of the interesting realities is that many companies, as the market reset, did raise some sort of structured instrument. And so being disclosive and thoughtful around that, around how it converts at an IPO, around how it may dilute shareholders, I think we're seeing more of that. In my world, there are fewer with leverage. I agree with the ratios and the philosophies that have been mentioned. And I'd also say that how quickly one delevers is incredibly important. I think being 3 times levered and 1 times levered a year later is very different than a low growth business attempting to sustain a larger sort of quantum of debt.
No, that's well said. I'm chopping out one question because I want to give enough time to all y'all on financial guidance. It's something that I have very strong views on here, but nobody's here to hear my views. So let me go to you, Kimberly. How should companies coming public approach financial guidance? Do they give it? Do they guide conservatively? Do they try to excite everybody and overpromise and try to overdeliver? What's the secret sauce?
This is something that we could spend an entire hour on. It's
Yes.
something that I'm very passionate about. The enemy of valuation is surprise to the downside. Okay. And so with that in mind, I think it's very important that for the rest of the current year, quarterly guidance is given. And then annual guidance, preferably for 2 years after the current year. So a total of 3 years of annual guidance, including the current year, and certainly quarters for the rest of this year. Now, if you're pricing an IPO in October and you're sort of in the fourth quarter, then you really need to give 2025 quarters as well. The reason that is critical is that both the buy side and the sell side expectations can be very much aligned. And everyone knows what they're looking for going into each quarterly earnings call. And it gives a company 3 to 5 quarters to establish credibility with investors. That credibility is the basis for a higher valuation over time. And as I said, downside surprises are certainly the enemy of that. I would always, there are a lot of debates, and I think intelligent people can certainly disagree on this, but I would very much encourage a practice of conservative guidance, particularly over those first 2 years. You want in a sort of 90% of outcomes scenario to be able to make or beat the guidance you're given, that you're giving as a company. And that will allow the market to develop a level of trust that management has an ability to deliver on its promises. And over time, that kind of consistency and ability to meet expectations absolutely translates to a higher multiple, a higher stock price, and a greater value for the corporate entity. So I think, to me, it's just sort of essential prudent practice. I have seen, there are occasionally inside shareholders, they might be private equity or otherwise, who want a sort of to maximize the value at IPO. And I certainly understand wanting to get as the best return on investment for your private shareholders as possible. The problem is that unless you are issuing 100% of your interest at IPO, that tends to be a more short-sighted view. So if you can promise conservatively initially, deliver, meet or beat your expectations over time, you'll be able to sell the rest of the value of the company at a much higher valuation because you have established trust and credibility with the investment community. And I think it goes to management credibility, it goes to credibility of the business model. I think, frankly, it's just a best practice.
So let me just that's awesome. Thanks, Kimberly. Let me just touch the third rail here, Barbara. Why not take a page out of Warren Buffett and don't give any guidance?
There are companies that have done that, but I agree with everything Kimberly said. It just makes it more difficult for investors and for investors to get a sense of what should I expect here. I mean, we can all look at history, think about what we think, and take our own stabs, and we do, at what the numbers ought to look like, and then see what happens. But the company, if there's a vacuum out there, it just makes it difficult, particularly if there's any volatility to the downside in the results, for the company to deal with explaining why something happened. It's just the reality of being in the public market.
So Jane, about a week ago, so Netflix comes out, they report earnings, and everybody's looking at the numbers, but they're now pulling a piece of guidance away from the investing community and, journalists such as us. I mean, do you think companies coming to public market over the next year, or whatever it is, are going to use what Netflix did and say, hey, you know what, we're not going to publish that number, or we're not going to give enough guidance?
No, it's a really good question. And I think Kimberly articulated really well when you are going public, how does one engage with research analysts in this deep understanding of what the model, like that is a point in time. I do think great companies can and probably should evolve the way they guide over time. Being a billion-dollar public company with a shorter track record and being a 50 or $100 billion company, your priorities change, the way you run the business changes. And we do see great companies move from time to time from quarterly guidance to annual guidance, from talking about revenue and EBITDA to talking to free cash flow to GAAP net income. We tend to think, if positioned correctly and aligned with the objectives of the business and how you're making financial decisions, I think those things can, for the most part, be done transparently and precisely at different stages of a company's life cycle.
So hypothetically, Jane, let's say if Yahoo Finance is coming public in a year, what type of guidance should I put out? So should I just assume, let me guide conservatively so it sets up the next year of beat and raises?
Yeah, look, all of our data, let's say you're very focused on your employees' perspective on the share price and you'd like to dampen volatility. I think the best path is to ensure you don't miss those first 2, 3, 4 quarters. That's incredibly important on conservatism. And then the second piece on what are you guiding and what are you talking about is really going to focus on your financial profile and what you're committing to investors. Are you trying to maximize free cash flow per share balanced with growth and market share gain? Those are the types of frameworks that I think will help an illustrative Yahoo Finance or someone like that talk about what's the top line metric you're guiding on and how should that flow through to profitability, to earnings, and how you're setting expectations with investors.
Hey, Yahoo was public, as we all know, ticker symbol YHOO. So who knows? Maybe we'll be back there. But let me stick to time here. Much I want to talk about Yahoo. With a wrap-up question, we'll just go around the horn here. Barbara, I'll start with you. I'm sorry, Kimberly, I'll start with you. What's the biggest piece of advice for companies looking to go public? I think the research from Edelman Smithfield really highlighted it's been challenging for some of the companies that came public in 2021.
I would say start with your story. Stories are the things that investors will absolutely remember. So if you're thinking about a company, what's the origin story? What's the reason for that business to exist? why, this is sort of the inventory of questions to ask yourself as you take an inventory of how you want to present yourself to investors in the street. But the origin story, why do we exist? Why are we passionate about what we do? Why is it that we are really competitive in the market? What brings consumers or eyeballs to us? How is it that we sustain our differentiation? How do we grow over time? What are the natural adjacencies? I think rather than thinking about the public markets first, it's really important to take a self-inventory and really, know thyself. Once you know who you are, why you are, and what makes you different and better than the competition, then it becomes a very, very easy process of crafting your story and then putting financial metrics around it that support the narrative. So I think the process is really, really simple, but it must begin with, a sort of self-reflection or self-inventory.
Jane, over to you with a slight tweak. Obviously a lot of companies that are going to come public, they're in many cases founder-led. How are some of these founders different today than 3 years ago, and what advice do you give them?
Yeah, it's a great question. And I'll try and marry the two. We're often reminded that founder-led businesses, by the time they're coming public, it's because they've had tremendous success making decisive decisions and growing innovative businesses. I think the IPO, back to Kimberly's point on objectives, I find in founder-led businesses, defining one's objectives on that path to being public is really important. What does it mean for the company and why is it strategic? Is it a branding event? Are you focused on shareholder partners for the next decade and your relationship with them? Is it about price maximization? Is it about your employees? Is it about having a currency to do M&A? But I think the founders that do best in the process and set their companies up for great success have a pretty clear hierarchy of why the IPO as an event is important for the company, and why it's going to create another decade or more of sort of great execution.
Barbara, final word to you.
First of all, both Kimberly and Jane articulated critical points. I think companies need to prepare themselves, understand what they're getting into, build relationships with investors as early as possible. We see many companies coming around and meeting with us when they're private, before they've filed an S1, so that they can get to know our side of the business and the concerns and questions that we have as outsiders looking in. Companies ought to listen to conference calls, understand what works, what doesn't work, why investors and the market react the way they do, and also understand, are they really ready? I mean, this is the beginning, the IPO. One of my favorite stories is Yeti products, which is public now.
Great bottles. Oh, I just bought one of their chairs, Barbara, for $300.
They're really good.
I'm sorry, I got it as a birthday gift. My girlfriend got it for me. And this thing is awesome. It will withstand a hurricane. This thing ain't blowing over. It's great. I love it stuff.
Well, Yeti came around to meet with investors in, I believe it was 2016, and pulled their IPO. And why? Because their inventory was in too many places, and they were growing really fast, but they were on the precipice of blowing up because their inventory was in the wrong places. So the CEO, who's still CEO, pulled back, pulled the deal, pulled the inventory from places it shouldn't be, started to build the direct business, focused on the brand, and then came public a couple of years later with a much better positioned story, a much more financially sound business, and a much more durable business. So I think understanding, are you ready, from a number of vantage points is really important.
I want to quality control myself and not talk about the competitive threat of Stanley mugs. So we're just going to leave it there. I want to play a little bit of a hype master. So we're taking questions. Please feel free to submit questions. We'll get the group to answer. We do have one we did not answer throughout the session, and I think it might be more applied to Jane, at least initially. So the question from Tana Zhang, what key factors should Asian companies consider when evaluating the decision to pursue an IPO in the US rather than their home country or other global markets?
Yeah, look, the first piece of this is regulatory, and we've obviously been through sort of different regulatory norms and requirements. I would put that as a gating item in any decision, based on where the company is regulated. The second piece, though, I would say we've seen lots of success with listings outside of headquartered country. That's a broad statement. That can be Asia, great companies in Western Europe, great companies in Latin America. Have chosen the US as a listing venue, and I think are well understood, well followed, well invested in. And so it's really a question, I think, often of what that growth leg of the company is and where you think investor depth and understanding will be best suited for a public shareholder base.
Barbara, I think I can get you into this one too. Tana mentions, I think, in her question, or maybe brings up a key point. How do you evaluate companies in an environment where the geopolitical tensions are very high, especially ahead of election season later this year? If they have more business in emerging markets or in China, do you evaluate them differently today than you would have, let's say, a year ago?
Well, I mean, it certainly adds. Being international is terrific because it adds a lot of tentacles of growth, but it adds an element of risk because the further the business is from where we sit, the tougher it is to evaluate. There are language barriers, there are time differences, there are cultural differences. So we need to understand the nature of the business in different markets, whether it's done directly, whether it's done through distributors, what the relationships are like. And we try to find third-party sources to give us comfort with the soundness of the business and the risks we identify. It's a mosaic.
Yeah, no, that's really, Jane, lastly, to you, what is the, when you're looking at the IPO pipeline over the next year, what is the appetite for, let's say, a Chinese tech company to come public at this point?
I think it's probably incredibly situation specific.
Sure. Yeah. Interesting. Well, I think we're coming up on time. I mean, this was the coolest, most impactful thing I've done all year. So I thank you, all three. This is really, feel like I just went to school in a good way. But thank you for your time. And let me get Ted back in here. Ted, over to you.
Thank you, Brian. I want to echo Brian and thank Jane, Barbara, and Kimberly for joining us today. This was a really incredible conversation, really relevant to the state of the IPO market. So hopefully you all that dialed in found this valuable. I also would be remiss if I didn't thank my team. We spent a lot of time with this research, multiple months in the field interviewing investors. And so particularly Ashley Furlan and Ashna Vasa, among others on my team. This is important research for us, so I just wanted to thank them. But to all of you that dialed in, thank you for your time. And to our panelists, thank you again. And we'll hope to see you all soon. Thanks, guys.
All right. Thank you.
Thanks all.
Thank you.